All right. This is the first video of the trading journey, you could say. It's going to be very boring. I apologize, but if you want to be profitable in 2025, I definitely recommend just sitting through it, listening, and writing notes down, journaling. If you're on a paper account, this is for people that aren't brand new to it. I definitely recommend getting on Notion and actually um, throwing your trades onto a calendar or something where you could actually just journal your trades to, you know, look at them. But let's get into the video. So, for module 1 lesson 1.1, it's the introduction of futures trading. So what are futures contracts is what we're going to go over. Definition and mechanics of future contracts, understanding long positions and short positions. That's a big thing to learn. I mean, it's not super hard to learn, but once you understand it, I mean, it's just cake, basically. But don't think that's it. There's so much more with trading. It almost took me 3 years. I think I've hit 3 years with just teaching myself trading. Like, I mean, YouTube videos helped a lot, mentors. Like, if you have people to talk about trading with, I definitely recommend it because you can bounce ideas off of each other and you guys can grow as a team together. And if you have a mentor, I mean, it's kind of difficult to find a mentor, but you just have to be blessed and you have to like really put yourself out there. You can't be shy when you trade, you know? Put yourself out there, network with the right people so later down the road you have a good foundation on people you can fall back on or ask questions about. So um so what are future contracts? Future contracts are making bets. So don't get scared of the word bet. I mean, it is a bet, but it isn't, if that makes any sense. You just think the price is going to go up or down from that position. So you can trade anything, gold, oil, stocks. I mean, that goes. I mean, there's a ton of stuff that you could trade with the futures. But you think the price will go up or down with a set deadline. So say I'll actually that's farther in the lesson, so I'll wait on that. And don't get scared because you can have set strategies when you go into the market. And it gives you more confidence and win percentages on taking trades. So that's a whole nother thing. Like, I'm not going to try to put everything on you guys right now. You guys need to learn the fundamentals of trading. So later down the road, you can actually learn strategies and like have the confidence and see good trade setups in the future. So, so future contracts. It's betting on price movement. So you buy or sell contracts, future contracts, because you think the price is gonna go up or down. And day trading is by the end of the day. So it could be from 10 minutes. So like you get in the market, it could be 10 minutes after that you close that position, and you either make money or lose money. But it could be hours, whatever. And then no ownership. This is the thing I really like because back then I mean, you didn't really have to because the stock market has been around for a while. But back then, like gold and oil and all that other stuff, like you had to have the actual like physical thing and the price would go up. I mean, still with gold, like people invest in the gold and actually buy the actual asset and they hold on to it for decades or whatever. And then the price moves up, they sell it. But with the futures, like day trading, you don't have to buy the asset, you buy a position and you think it's going to go up or down. So just on price change. And then quick moves it's day trading. Usually buy or sell, like I've been saying. Same day. Yep. And then you make profit with small changes. So you buy in and it goes up a certain amount and you take out and you make that profit. That's a long position. And it is later down the road in this lesson, in this video, so don't get worried on that. And leverage. So leverage, I mean, you can control a position with less money than the actual thing. Like I said earlier, with gold, you don't have to buy a gold bar to like actually have it. Like you just buy a position in gold. So if we go over to my trading view, I have all my whatever indices, commodities, whatever, or indexes, I mean, not um but gold, right? 2,900 bucks to buy a position for a sell or for a buy and a sell. But I can buy a position here and it will show that I'm in the trade and it either goes up or down. So I'll teach that, or I'll show you guys that a little later. But like I said with this earlier, so you guys don't feel left out if I didn't say it, but in day trading, it's just price moving over short periods of time without actually owning the asset. So, like I was saying. Definition of future contracts in day trading. In day trading, futures contracts an agreement to buy or sell an asset. So you don't have to actually have the asset. Like I hope people understand, you don't have to actually buy a gold bar. You just buy in the market that contract. And it's just on a predetermined price. So with gold, how it was at 2,900, you buy it there, and that's the predetermined price. And you think it's gonna go up or down. And you either close, like with day trading, it's closed usually in the same day, so you don't hold it longer. There is different trading like strategies, you could say. I mean, yeah, I guess you could say strategies, but there is different ways you can like trade like long term or whatever, but we won't talk about that because we're just day trading, because I only day trade. So but yep, opening a position for day trading. So this is you either going long or a short. So when you go long, you think the market's going to go up in price and you're buying it. And when you sell the position, or when you sell, you think it's going to go short, and that means it's going to go down. Pretty self-explanatory. So when you buy a position, you want the market to go up, and you sell even higher. But when you when you're selling a position, going short for that position, you want the market to go down, and then you sell that short position even lower than you went at, or the set price was. So you're making predictions on the price movement of the market, basically. So, yep. I mean, for example, if a trader believes that the price of oil will rise, they might buy a crude oil future contract. So you don't have to buy actual crude oil; you just buy a contract of crude oil. And if they think it will fall, they might sell short. So sell is short. So when you sell a contract, you think it's going to go short. It's different from buying a contract and selling high. That's different. But I definitely recommend journaling. So I would write this down, get your notebook, type it on a computer. I mean, if you want to do it on your phone, I don't really recommend it on your phone, because you just like, it's your phone, like you want to see it physically, like on a piece of paper in front of you, solid, not glowing at you. It just feels better. That might just be me, personal preference, but I definitely just recommend writing on a piece of paper or just on a computer, whatever, but just don't do it on your phone, because it's just too small. You can't really see. You have to scroll, whatever, do it. Oh, yeah, it's not, I don't recommend it, but. And Next is leverage. So leverage, it's just like margin, and it's just, you think it's just like what's the word I'm trying to find? Like, you don't have to buy the whole like, yeah, right here. So you don't have to buy the whole 1,000 barrels of oil. Like, you only take a small percentage of it, and when it increases in price, you sell that position to someone else. Because in day trading, you're not just by yourself in the market. There's millions on billions of whatever people in the market at all times. And you're basically trading with people positions to make money. So when you win in the market, someone is losing in the market. Say you put $100 in and you win $100 off of that $100 trade. Someone lost $100, so you just got someone's $100 in the bank. But when you lose in the market, you say you lose $100. That $100 goes to one, like, not one person, but to a different trader, you could say, or traders. I don't, either way, but you guys get the point. And then for closing positions, I mean, it's just pretty pretty simple. Closing positions is when you buy at, say let's go back to the trading view, and we'll go to the micro ES. So say you buy at, we go at the 1 minute, it's just a little easier. So and this is gonna be, I'm gonna probably go through this one more time just so you guys understand it. So say I buy, we're on my paper trading account. I'm not gonna actually be on my real account, but say I want to take my take profit to be $10 and my stop loss to be $10. And if I buy this position, I think it's going to rise up to $10 and I'll take profit. But I'm also risking $10 to make $10. Obviously, you can go more and more up or whatever, but I'd recommend staying at a 2-to-1 ratio. So for you risk $5 to make $10. So if you lose this, you can make another trade and um risk another $5 to make another $10. So you break even or make money on that day. So I hope that kind of makes sense, but and then yeah, I mean, this is exactly what I was saying. You don't actually own the asset. You don't own 800 barrels of oil or 2 tons of wheat, whatever. It's like a contract. You buy a contract, which is basically you buy at a set price, and you think it's going to go up or down. So, yep, short time frames. This is a little bit more confusing because it's just going to be, oh wait, I'm actually thinking of something else. So, in day trading, future contracts are usually traded over a short period of time, like hour to minutes, or I mean, yeah, hours or minutes. The goal is to take advantage of small price movement to make profit within the same day. So, I mean, if you want me to go more in depth into these, just let me know in the comments, because I mean, I am moving kind of fast with these, but I want you guys to understand like a little bit. And because when I first learned trading, I I didn't really understand. I had to watch a video like 3 or 4 times to actually understand it. Plus, I mean, I wasn't really journaling like what I was learning, cuz like I just I wasn't 18 yet. I was 17 and I just was like, am I really going to do this? But working a 9 to 5 job getting paid 15 to 17, $20 an hour is not worth it when you can make $100 in 10 minutes, you know? Although it is risky because you can lose $100 in 10 minutes. So it's not like, oh, it's easy. It's not easy at all. Like 90, I don't know the percentage, but like 97% of traders are unprofitable. And it's very difficult, but once you understand trading and many things about trading, you don't have to know everything about trading. The less you understand about trading, the better you'll be because you won't overcomplicate things. You'll look at one strategy and you'll take that strategy so far. That's how I am. I just use basic ICT strategies. Like you can watch his videos. I definitely recommend it. So those are like fair value gaps, order blocks, all that, liquidity. You'll hear liquidity a lot in the market. You just want to like it's good to know about everything in the market, but once you learn one set strategy and you master that strategy, you will go farther than one person learning 10 strategies at the same time and not going anywhere and not mastering all like one of them, you know? I'm not saying you can't learn 2 to 3 strategies, but I definitely recommend just sticking to one strategy, using that strategy, back test, and making it like your your mastered strategy. So you, in the market, you just look for that thing, and once it hits, and you have that strategy, and you hit 63, 64, whatever percent of the time, you're going to feel great because you mastered that thing. And once you master one thing, it's really easy to master many things. So just take it step by step and definitely just take it slow. I mean, I don't want you guys to learn everything in a month because you'll be overwhelmed and you'll just like burn yourself out. Take it slow. So like trade 2 weeks straight, take 5 days off, and then 2 weeks straight. Like refresh your brain. You don't want to just like burn yourself out with trading. So yeah. I probably have so much more to ramble on about, but I don't want to make this video 20 to 30 minutes long. Well, it's about to be 20 minutes, but I don't want to make it 30 minutes long. It might go to 30, but I don't know. But explaining day trading. So you buy a stock contract like the S&P 500, which I trade at 10 a.m. for $1,000, expecting the price to go up by 2 p.m. So that's 4 hours. So in 4 hours, you'd make $50. Doesn't sound like a lot, but once you have more money in the market and you have more contracts in the market, you can make a lot more money than just $50 in 4 hours. So, and the price moves to $1,050. The trader sells the contract, making a $50 profit on that $1,000. And you do have risk management when it comes to this, so just don't think you're gonna buy at 1,000 and it'll go up to $1,050 in 4 hours because it won't. You have to look at the market. You have to like see what's happening. You have to get your daily bias, which is going to be a whole different thing. So, why day trading futures? Uh, or why do they use it? I'm sorry. Leverage, obviously, more control with less capital. So, capital is your money. So, leverage, you can have a 1 to 10. So, they leverage you um, money. I'll go more in depth with that because you're just trying to learn the fundamentals right now. Liquidity, you'll hear a lot of liquidity. So, and that's like, has many things. It's just liquidity is basically a lot of buying and selling positions going on all the time. And that's a whole different thing as well to learn. So I'll make a YouTube video on that probably later down the road. I don't know when, but I'm gonna try to post these at least daily or every other day, just depending on what my schedule is, because I do have a lot going on. But I hope these do help. And like I said earlier, like if you guys want to comment and ask questions or follow me on Instagram, message me, and I can help you out with something. Because I didn't really have that when I was going through trading, and my whole like I think I started freshman year or at the end of freshman year. I'm not sure, 100% sure, but it's been like 3 years. But I never had someone to ask. Like, yeah, I had people on YouTube, but like it was just comment section, and then I would like DM them or something, and it would just be kind of confusing on how to like actually understand the thing I'm trying to learn. So what I'm gonna do is I have a Discord, completely free. This is gonna be completely free, but if you guys want to like have a one-on-one, ask me any questions, or a couple of my coaches, you can definitely just join my Discord, ask me, or just text me on Instagram if like you're having trouble joining the Discord. We'll get you in there. I might be posting my trades in there. I don't know if I will be going live or anything like that, but that's for the future. Um, yeah, I mean, that's not very important to learn. But in summary, these are very important. I mean, I would write this down somewhere on your paper or your notes. In summary, future contracts in day trading are used for short-term speculations on price movements, with positions typically opened and closed on the same day without taking physical delivery of the asset. So you're not taking a gold bar and holding it for that day and then selling it to someone. You're holding a contract, holding it for set amount of minutes slash hours, and then selling that contract by the end of the day. That is day trading explained. Okay. And then in day trading, long and short positions refer to two main types of trades of, sorry, holy crap. Types of trades a trader can make based on their expectations about the direction of a asset's price. So long is up, short is down. You guys really need to understand that. So long positions. Long positions is you're buying a position, and when you buy a position, a long position, you think the market is going up in price. And yep, like I said, will rise right here. The goal to aim to sell the asset at a higher price later to make a profit. So like we were talking about earlier with the $1,000, we'll go back up to that real quick so you guys just have a visual of it, if I can find it. Here we are. So this is a buy. You went long on this position. So at 10 a.m. you went long at $1,000, and you just wait 4 hours. By 2 o'clock it's up $50. You sell that and you make $50 profit on however many contracts you have. So how it works, you buy the asset at the current price, so $1,000. You wait for the price to go up $1,050. Then the price will rise. When the price rises, you sell the asset to make profit, which is the $50 that you made off of the $1,000 when it hit $1,050. Example, another one right here. If you buy a stock at $50 because you believe the price will rise in value, and the stock goes up to $60, you can sell it for a $10 profit per share. And that goes, actually, I won't even go down that. So short position. So a short position is you selling And selling is a short position means selling an asset that you don't own, you know, typically borrowed by a broker. That's a whole different thing itself, with the expectation that the price will fall. The trader aims to buy the asset back at a lower price to make profit. Lot of talking. Holy crap. You borrow the asset from a broker and then sell it at current price market. Example, so you guys don't freak out on it. You wait for the price to go down. When the price falls, you buy it back at your lower price. Close your short position. You return the asset to the broker and pocket the difference between the selling price and the lower buying price. If you short a stock at $50 and sell it at $40, you make $10 profit. So when it drops $10, you sell that position and you get $10 profit. Key differences: long position, you buy the asset first, you profit when the price rises, you can only lose as much as the price falls. Short positions, you sell the asset first, borrowed, you profit when the price falls, you can lose an unlimited amount if the price rises. But once you have set stop loss and take profit, it won't be unlimited. In summary, long positions, write this down, please. These summaries are going to be the lifesavers for you guys. I'm not even kidding. Like, I wish I had like a mentor or a friend that would summarize this stuff for me, because just trying to summarize a whole video that's going to be, holy crap, it's been 30 minutes. 30 to 45 minutes long is very hard to summarize. So these little summary things that I give you guys are going to be your lifesavers. So write these down, please. So a long position, buy low, sell high, and you're betting the price will rise. Short position, sell high, buy low. Just the opposite of long. So long, when you think of long, think of buying up. Short, high, low. Simple as that. All right. And that's basically all we're going to cover for this video, just because I don't want to overwhelm you guys, and it has been 30 minutes. So if you guys have any questions, let me know. Follow me on Instagram. Text me. I mean, if I don't respond, I'm probably busy. But if you want to join the Discord, I am more frequently on the Discord, more just in calls, talking to people, bouncing ideas off of each other. So if you want to find a community that's just ready to grow, definitely join. I'll have it in the description. Definitely join it. And yeah, I hope you guys enjoy your day / night, whatever. And I'll catch you guys on the next video. I'm not sure when I'll post that next video, probably tomorrow or the next day. So, but just be on the Instagram if you need any help, or Discord. So, but I'll catch y'all. Have a great day.